Hey, and welcome back, happy investors. This time in this video, 5 dividend stocks that might be interesting for you as a dividend investor. This is a monthly update where we discuss a number of dividend stocks. Some appear more frequently, others are new, as in this video, a few new ones. Some of these dividend stocks have dropped significantly. This was already the case before the market crisis, but because the market crisis has now hit, they dropped even more. Of course, there's a bit of panic selling, and that really creates great opportunities. For a long time, I wasn't super enthusiastic about the stock market due to the overheated situations. But now it's time to be very enthusiastic and optimistic again. It's not yet the perfect moment to start buying heavily. This crash might persist for a while. The uncertainties, I've highlighted that often in our monthly portfolio updates. Be sure to follow those for more updates on what I do with my own money. That's more important. What I do is more important than what I say. But in this video, 5 dividend stocks that we follow from time to time. We continue. Some have dropped significantly, others rose a lot initially and are now falling extra hard because of that. But all 5 have something in common, and that is attractively high. Dividend plus dividend growth bought for the coming years. Let's start and look at these dividend stocks. The first stock is Teleperformance, which is not immediately an obvious dividend stock, but it does have massive upside potential. Teleperformance might achieve more than an average return of 50% per year. Sounds very exaggerated, but I have covered Teleperformance more often. I first bought it at a price level of around 97 and then bought more twice. The last one was at 81. Conversely, I did sell some more, again at the same price level of around 95, but that's purely to slightly reduce the position. Because I had bought more twice at a lower level, I had a bit more profit, about 10%, and not to trade because I generally invest for the long term. But this fit into my overall strategy, which, I have also covered in my monthly investment portfolio updates, that I have sold a lot from America. Some stocks are now all in the red. It doesn't look very promising, but I have a lot of cash flow in the Giro. Cash flow at Maxim, and I have more than almost 70% cash at the moment, so quite a lot. So we are going to benefit greatly from that. And I think that Teleperformance, if it drops a little further, it becomes interesting to buy more. But because of the entire market, the events might cause it to drop a bit further. And that's only favorable because Teleperformance already seems very cheap. The fair value asset, according to Morningstar, is significantly higher at 143 euros. Still not too bad with 3 stars. They indicate that according to their insights, in the economic mode, the advantage is limited. But in any case, there is a certain advantage. Teleperformance is a call center, but on a global scale. They have a very interesting strategy. We see something being done. First, a major competitor in France. That seems to have been bought off at a good price, a good EBITDA price. Analysts also think, by the way, that the price target is much higher than the current potential. And the management continues to pursue those acquisitions. They have also switched management. The founder, who has run the company for 20 years or more, is stepping aside. And then the new CEO arrives, hopefully with more hunger and a bit more driven. We will see. It is not a superior company. It is not a great company, but it is an asset-light company. That is interesting. And the stock has dropped significantly compared to 2021. Here, of course, strongly overrated. Only this decline is the result of actually a correction based on overvaluation. And then artificial intelligence made the news. And yes, call centers could be disrupted because of that. Still, I have been following companies for quite a long time, and I think there is potential here if we only look at forecasting. And if they were to return to a multiple of 15, so a price to earnings of 15, which is much lower than the historical multiple, which is equal to 18, they could achieve more than 50% average return per year over the coming years, and actually a total return of 250%. So your investment times 3.5, if I am saying it correctly. And here we see the EPS estimates from analysts. Not super high, but attractive, high enough. They are also buying back their own shares in Teleperformance, so that also helps to push the EPS up. And actually, the only thing that's a bit disappointing is the revenue growth. Market Screener also gives a 4-star rating from investors, especially the valuation looks attractive, and that is the advantage of Teleperformance. They are just relatively cheap in terms of shares. The price to earnings ratio at the moment is around 10, and then you are estimated around 7. The PEG ratio is below 1, and the price to cash flow is only 3. Super cheap if you ask me. Of course, there are also disadvantages to that artificial intelligence thing. That indeed, and ChatGPT and all sorts of developments might not be entirely great, favorable for the poor call centers, but Teleperformance indicates that they have invested 100 million in artificial intelligence projects. And I think myself that they can actually benefit a lot from it because they employ a lot of people. And if they can provide the same service with fewer people, then that profit margin should increase, I think. But of course, competition is also a factor. Well, the dividend yield is 4.5%, and it will only increase if the stock becomes cheaper after market declines. Keep in mind, although they do have 1 billion in cash, they also have a considerable amount of total debt. So there is indeed a bit of risk. This is due to 3 billion in acquisition costs to take over the competitor in France. And they have invested another 500 million in another position from America. And they make technology for virtual calling and such matters. When we look at the good figures, they didn't seem very favorable. These have since been adjusted upwards by the management. We see here in the model, for example, that EBIT growth is projected at about 10% for next year, revenue growth of 10%. These are not all superior figures, but you don't need to grow exceptionally fast if you already have cheap stocks. Return on equity, nevertheless, is still 12%. Also, not superior, but in the past it was slightly higher. And I'm very curious to see what the effects will be of those investments in artificial intelligence. It will probably be disappointing, but who knows, it might turn out positively. A bit summarized. Often when you have very cheap stocks from companies that have a small advantage, the advantage you have, it can often turn out better than worse. But well, the overall market ensures that the stocks continue to decline. Well, it's not really the dividend. Truly, because they do pay out 4.5% dividend, and they have been paying out dividends for 10 consecutive years. So that's okay. But the dividend growth is not that remarkable. We can take another look at it. Dividend growth at the moment is quite a lot, 10%. However, the 5-year dividend CAGR is only 2%. So yes, there is certainly a much better dividend. Stocks are, but here it's about the total package. So actually, you can better describe it as a value stock. With currently quite a reasonably high dividend yield. Due to the recent declines, Teleperformance has also further decreased because of the market. And the last time I heard something about it was around the price level of 81. If you zoom out a bit, it might be that a better dark price will emerge. And I would think from this point, Teleperformance is already interesting to buy. Anything below 85 euros. But if it drops to 82 euros, then there might be a support level there. Zoom out a bit more for the longer term. If you believe in a bit of technical analysis, then there might be a support level around the price level of 75. We see the current market development could easily mean it just continues to drop to that 75, or maybe even much lower than that. But in principle, those shares should only become cheaper then. However, keep in mind, all those import increases, tariff increases, you also have an impact on Teleperformance. On the other hand, it is an asset-light earning model. It could be that those tariffs will naturally decrease again or are temporary. Who can say? I am very curious to see how it will go. Overall, I think that Teleperformance will decline less sharply than other stocks, simply because it has already dropped a lot and now has an attractive valuation. Certainly, regarding the long term, because I do believe in this company, not that it is superior, the study model is not superior either. Even if you have artificial intelligence, services will always need customer service. Customer service will always have a human element. And I don't think we are there yet in the coming years. That artificial intelligence can accurately interpret human emotions and reassure people, for example, over the phone. And that is essentially what this company does. The retail giant Target Corporations with the ticker PGT has dropped by about 65% since the all-time high. A massive price drop. And when you talk about dividends, well, this company has been paying dividends for 56 consecutive years. And I don't think they want to undergo that break. But the company has been hit by several issues and now further impacted by market developments, which is making the stock really start to become cheap. Perhaps even dirt cheap. We'll see. Morningstar indicates that their fair value estimate is $135. But they also mentioned that the fashion trend is negative. Moreover, you always want to compare target corporations with, for example, Costco, which still has a relatively high valuation, but it is clearly a strong winner. So the question is, yes, should you invest in the number 2, the first loser, or the number 3, number 4? Well, that's a bit doubtful. Personally, I don't find it super interesting enough for long-term investing, but as a value investor and dividend investor, it can be very interesting. Morningstar gives a 4-star rating. Refinitiv ratings from Wall Street analysts expect an upside potential of 42%. They are often wrong, as you can see. Looking at recent historical developments, the stock seems to have become undervalued compared to the price to earnings ratio equal to 15. And this hasn't happened but very often for Target in recent years. Therefore, upside potential, I have set the normal multiple at 15 based on the last 15 years approximately. And if you are to believe the EPS estimates from analysts listed below mentioned, then it does have a significant attractive potential, namely perhaps even averaging more than 20% per year. Well, that is quite high. The price to earnings ratio has also dropped to 10.7 at this moment. And yes, it might drop a little further. From Market Screener, the stock receives 4.5 stars. In a moment, we will take a look at some entry points. The price to earnings has thus dropped to 10.8. For next year, it is estimated to be around 10.5. Other tools are somewhat similar in terms of estimates. Of course, it's even better if you have your own estimate. The price to sales is only 6. The dividend has meanwhile increased to 4.6%. They do have somewhat higher debts, so naturally pay attention to that. Also, watch out for the competition. Revenue growth seems actually very limited due to the competition as well. The EPS long-term growth of 2% estimated in this model is really on the low side. So the question is, to what extent Target that can outperform profitability? What stands out to me? Low margins, but that is typical for the business model. But high return on equity. And actually, it surprises me that this company has such a high return on equity based on the 5-year averages. I don't quite understand why then the stock is dropping so sharply. So there might be an opportunity here if they can continue to generate higher return on equity within the business model. Yes, then sentiment placed will naturally lead to stock price increases because they can then simply generate much more cash. For 56 consecutive years, they have been paying out dividends, and the dividend streak is also 56 years in a row. So that is quite remarkable. Not many companies can replicate that. So when you talk about dividends, well, this is a really strong dividend stock. Dex rank indicates a hold rating, which I don't quite understand because their price target is significantly higher for the next 6 to 12 months. $131. Still, despite this, the stock has plummeted significantly. The current price is well below the EPS chart. So there might actually be a real opportunity here. If we look at such entry points, there seems to be a real entry point around the price of 108. That's the downside of technical analysis. If you only focus on that, then that's definitely not good. You should always look at the fundamental analysis. But we have already established that Target's shares do not seem very expensive, at least. If you look at, for example, the price to sales ratio of 0.4, yes, price to cash flow of 6. Well, that profit might decrease due to all the rate increases. That also impacts this revenue model. Only the revenue, perhaps that could remain stable, and that it might actually benefit. Since people will naturally and slowly, cautiously and carefully start saving and buying on budgets. Are we looking at an entry-level model? Still, if you look at zooming out over the long term, then the stock, which is almost reaching 88, might find a strong support level there. Whether it will happen, no idea. After that, the price level is at 81, but that's all about looking at charts. Fundamentally speaking, high dividend, relatively cheap price. It can always be cheaper, especially if profits decline in the short term. But for the long term, it might have potential, an attractive investment. What is definitely needed is holding on for the long term, and I would also reinvest the dividend, which means you will only benefit more if there is a recovery for this company. First of all, the company is involved in life insurance and financial products. Well, the interest rate is still high, which can be perfectly fine. I believe life insurance is a basic necessity for people. When it comes to cutbacks and tough times, it still seems to me like something that is needed. The price target from analysts is 26% higher. Morningstar provides a fair value estimate that is also slightly higher than the current price. The current price has also recently dropped a bit. This could present potential opportunities, and they indicate a limited economic moat and, in other words, a small competitive advantage. So I focus on screening, and one of the screeners I use is, for example, from Fastcrafts, and it mainly looks at, let me put it this way, and you can use it very well if a stock has a long-term history, and then you can closely follow the historical valuation. It seems that after the recent price drop, the price is significantly below the normal valuation, and that doesn't happen very often, as you can see in this chart. The price is the black line. Simply put, if it is below this orange line, what the fair value words consist of. This is often price to earnings, equal to 15. So 15 times the earnings. You see that it doesn't often drop below that. And if it does drop below, it's actually quite significantly below. But we also need to zoom in a bit and also look at the shorter term. And with more current data, we see that it has indeed dropped below. It will probably drop a bit further, so then it could form a nice opportunity to follow. Well, the current price to earnings was 15. It has now quickly dropped to 12.3 in a short time. If you were to buy at this moment, theoretically, if the below EPS estimates are realized, which is never 100% the case, then you would have an average return of more than 10%. And that seems quite attractive compared to other stocks. If we look at some ratings from the market screener, they actually have a rating from the investors. So that is quite remarkable. Financials seem good. Valuation is solid. It mainly comes into play if they have, for example, a higher book value. We'll look at that in a moment. We look at the price to earnings. Yes, it is slightly higher than the sector median. For example, you also have Allstate, which is more into insurance, and there are many other companies like that. For example, in life, health, insurance. Well, and in their sector, they rank number 5 out of 19 based on this factor analysis. Yet they receive a buy rating, and actually because all factors look good except for the valuation. And that also has to do with the price to book ratio, which is very high. So further investigation is needed here to understand why that is. I also noticed the debt position and dividend yield. We are looking at dividend stocks. The dividend yield doesn't seem very high, 1.4%. Yes, it isn't. But if we talk about dividends for a moment, they have had 14 consecutive years of dividend growth, and they have also paid out dividends for 14 consecutive years. So this is one that is contending to become a dividend aristocrat. Interesting. Revenue growth, not very remarkable. EBIT growth was good. And of course, we are mainly looking for EPS growth. This is also not provided in this model, even though the cash flow growth was good, but this was all based on this year. So I am curious about how this company will develop. What really stood out to me were the margins. The EBITDA margin is relatively higher than the sector median. The 5-year average is also somewhat higher, but I mainly look at, for example, return on equity. Very high, especially compared to the sector median, and the 5-year average is also just high. Return on capital is also somewhat higher than the sector median, so they must be doing something right in their revenue model, and that's why I find it interesting enough to investigate further. So I do expect that price E has come up more often in our analyses. X-ring indicates a hold, and based on technical analysis, we use a long-term indicator, and it currently indicates a sell. Yes, makes sense. So a lot of stocks are getting a sell signal at the moment. The MACD is starting to drop significantly. Negative momentum, that's all quite clear. Of course, we are mainly curious about a possible first interesting entry point. It could be, if you look purely based on the support level, if you want to look at it that way, such technical analysis, then it could be at 213, the price level. That would mean a nice new decline. And we'll take a look at what percentage that actually is. That means another drop of about 13%. Yes, I don't rule out that it could fall even further. We'll see. Interesting, at least for further research. Another potentially interesting dividend stock for the long term is JP Morgan with the ticker JP. JP Morgan has a strong economic moat. That's what you want to see, of course. Morningstar does give a lower fair value, estimate of around $195. As we will see in a moment, it is also at a certain support level, which might be interesting. Morningstar does indeed give only a 2-star rating. Analysts from Wall Street, and there are quite a few, really think that JP Morgan has a higher price target. The stock dropped significantly due to the natural panic in the market. I think it will go further. It can go down, and possibly that presents a nice buying opportunity for the long-term dividend investors, because we are, of course, mainly looking at the dividend aspect here. If we look at the valuation based on historical development, we see that the price has now fallen below the fair value of that price, earnings of 15. However, for JP Morgan, we mainly want to stick to the normal multiple. And then we see that it has actually fallen exactly on that line after the recent price drop. Why do we want to use the normal multiple? Because it is simply somewhat lower for this company, a financial company. It's not, for example, a technology stock where you would pay a price, earnings of, let's say, 20. So we assume a lower multiple. And actually, if you want to have a margin of safety, you will ask for an even lower multiple. The estimate from analysts is still an attractive EPS growth. This means that if this stock were to remain at a price to earnings ratio of around 12, for the next 3 years, it could offer an average return of about 10% in total. But I think with a slightly lower risk profile compared to the S&P 500, which has a higher valuation. On the other hand, it's a bank. You know how things can go if there's fear, panic, and a recession comes and something happens. For example, with finances, then things can suddenly go in a different direction with JB Morgan. But so far, it doesn't seem to be a cause for concern, because rate hikes, levies, that's not of the earth, a financial crisis. So yes, you never know for sure. But JB Morgan still seems to be just at least financially healthy. That's what we're also looking at high profitability. Well, that net income margin is high. And also in terms of revisions from analysts and also consensus, the stock scores reasonably well. Looking at circuit valuation, it's not super attractive or anything like that. Not that it's historically cheap. It's not at all, actually. Not. Dividend yield is also not super high, 2.4%. In terms of growth figures, not really many peculiarities. It is, of course, already a large bank. Growth will be limited. So we are mainly looking at the profitability. That might be interesting. The return on equity is relatively high, also on a 5-year average. In other words, quality, of course, a well-known name, JP Morgan. It is closely followed by analysts, so from time to time it might be efficiently assessed by the market. We are talking about market efficiency, and the recent price drop could therefore present a great opportunity. The history of dividends is attractively good. So they have been paying dividends for 28 consecutive years, which acts with 14 consecutive years of dividend growth. The dividend towards growth over the past 5 years is approximately 7.5%. Zexering indicates the hold-up rating, and their price to earnings is already somewhat higher, namely $260,000 compared to the current price. Regarding the entry point, the stock has already dropped significantly compared to the recent peak. A significant drop, as with all stocks. Then I may place a support level at a price level of 190, or perhaps a bit lower at a price of 170. That last one might sound low, but be careful. You never know how far the market can drop if real panic sets in. All in all, an interesting dividend stock, if it becomes cheaper, which I think is necessary, because it is currently just using the normal multiple, so that I could actually buy it now at intrinsic value, if the model is correct. Usually I would assume that a further price drop might be relevant, so you can buy it at a better price and valuation, and thereby also minimize your risk. Finally, a stock that has dropped significantly, namely United Parcel Service with the ticker UPS. Known, of course, in many countries. It has recently dropped by about 56%, and even to the level of around 2013. So a massive price drop. And let's investigate whether it is interesting as a dividend investment with a number of characteristics. Notably, the trend indicated by Morningstar is negative. So in other words, their competitive advantage is actually decreasing. However, it is still a strong competitive advantage according to Morningstar. Of course, we all know UPS. A disadvantage of the entire earning model is, of course, just a commodity with many competition based on price. So they will always have to keep developing themselves as the cheapest supplier just to be able to keep those margins intact, and possibly drive the other players out of the market. So it is a losing game for actually all parties, and there is only one winner, or maybe not at all if you think about, for example, drone delivery and such matters in the future. Fair value estimate is $140 according to Morningstar. That is quite a bit higher than the current price of 95. We'll see if they are right. Analysts currently think there is slightly less potential in the short term, but still an upside potential of 35%. Then look at the historical valuation. It indeed seems as if the price has now fallen below the fair valuation. This has actually only happened once before or twice before after the financial crisis, but that is the case for all stocks. And during the corona crisis, so in all crises, you naturally see something interesting. A buying opportunity arises. Still, it may be that the stock will continue to decline because UPS is certainly affected by all the tariffs. As a result, consumer spending simply goes down, and then fewer packages need to be delivered. And UPS is part of that. The scissors. So the current price has fallen further, probably in anticipation of what is to come. Notably, the normal multiples are quite high, even over the past 20 years. So let's assume a price-earnings ratio of 15. Still, analysts, a total of 30, think that UPS will grow in terms of profit in the coming years. This will be an average that may or may not be accurate. Let's say that the price-earnings ratio of 15 is correct. Then, from this current price level, UPS has an average potential of about 20% per year. Of course, a lot can still happen, and it could also be a falling knife. From Market Screener, investors give 3.5 stars, not very much. So the only thing that stands out is profitability, which is good. And enough coverage from analysts. Looking at a piece of valuations, the number seems quite cheap, with the price earnings for next year estimated at 12.6, and also a bit lower than the 5-year average of UPS. But also other metrics, not cheap. Price to sales of 0.9 is not expensive, but also not really dirt cheap. Price to cash flow looks quite interesting. And the dividend, because the price has risen so much, is very high at the moment at 6.6%. They do have relatively quite a bit of debt, so definitely pay attention to that in your analysis. Look at the growth prospects, which do not look very good. And this can only turn out worse due to all developments regarding levies. That will certainly affect United Price Service. Just look at the profitability. That is quite high in my opinion. I actually did not expect that for this type of company. And what I am looking at, for example, is the return on equity. Based on a 5-year average, it was even very high because that is also related to the coronavirus crisis, the recovery from it. But for example, the return on capital is also quite high. Net profit margin is not super high. Also because this is about volume business. So I am very curious how this will be in practice. They generate quite a lot of cash flow, and that is, of course, healthy. Why? Just imagine if local players in the market drop out, and UPS still has relatively a lot of cash flow. They could easily buy up these local players for a bargain. In other words, just expand on their own in terms of distribution. So it could very well be that they will actually benefit from all the tariffs and such, but that is something time will have to tell. Notably, the dividend growth over the past 10 years has been quite high, 9%. That's not bad. Looking at the history, UPS has been paying dividends for quite some time, 25 years, of which 15 consecutive years of dividend growth. So if you're talking about dividends, it's interesting to investigate further. Let's look at a bit of technical analysis. We see that the price has now dropped to the level of 2013, 2014. Can it drop further? Certainly. Let's take a look at a piece of the charts. If we look at the very short term, there is a possible support level at 93. Otherwise, it lies further down around 85. So that's a significant drop, actually to the level even of 2012. I really have no idea how far the price can drop. The only thing I know is that if those tariffs continue, UPS will be affected by it. And given the acceleration of the decline, it could be that the price in the short term simply continues to drop, albeit perhaps at a slower pace. We also see that in the MACD, which is starting to decline again. However, yes, a price level of 91, there lies a support level. So it's possible that short-term traders and technical analysts want to capitalize on that. If we purely look at valuation, and especially the historical valuation, it doesn't often happen that the price is below this black line here under the price earnings ratio of 15 for NASA UPS. So this could actually be an opportunity for fundamental investors for the long term. However, given all the trends and developments, possibly with a bit more shed, you can benefit more from the price drop. Time will tell. Thank you for watching. And I would say, let us know if you have a lot of in-depth knowledge about these companies. Share your knowledge in the comments. It is appreciated by many viewers. Thank you for that.